Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from The Wealthy Homeowner. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, this week the mortgage qualification rate is set to rise after the banks raised their posted rates. Even though the Bank of Canada did not increase their official rate, what should our listeners take from all this different mortgage talk? Why all the different rates?
Well, what you're watching happening right now, Jim, is what we forecast when this B20 rule came in. I think we've talked about it on the show here. What's happening, what you're seeing live is the banks manipulating mortgage interest rates to increase their profits at their local bank branches. What they're doing right now is, or what they did specifically last week was, they tried to create fear in the marketplace of rising rates. Now fear with the banks is created by raising the rates, which forces people which already have a pre-approved mortgage based on the old rate, which was lower, to go out and act within 90 days. Now, the banks play this game, and they play consumers, home buyers, like a fiddle. They've played this game on the exact same way year after year after year. Even in the most recent trading cycle, Jim, each time the market started to slow just a little bit, the banks immediately changed their interest rate strategy to try to allow fear to speed the market back up again, which in turn allows sales data to be used by real estate agents to try to keep the market going forward. And this is something that the consumer doesn't know what's going on. I believe the banks are doing it specifically to drive their own profits. So with the B20 rule, what it means is if you want to move to a new bank, you have to with an existing mortgage, you have to qualify at the new bank with the mortgage qualification rate. But if you stay at your existing bank, you don't have to qualify any further. They just renew your rate. So what the banks are doing is they have just imagine a giant spreadsheet where all of their customers their mortgage holders are on this spreadsheet. The mortgage holders' income, the value of their home, the amount of equity they have, how large the mortgage is, when the mortgage renews, what the monthly or weekly payment is, and they put all of that information on the spreadsheet or into the spreadsheet, and they have a calculation done with all of those numbers, how they interact, to record the best interest rates to derive the highest profits. They also use that spreadsheet to see what number of their existing customers or mortgage holders are going to be renewing their mortgages, for the sake of the argument, in May or June or May, June, July. And based on the composition of those mortgage holders, they look at their profit margins. They look at the ability of the majority of those mortgage holders who are set to renew, what their financial position is, and whether or not they would be able to move to another bank. If it's in the benefit of the bank to keep those people at their existing branch, they can take action with the interest rate to make that happen through fear and through the thought that interest rates are going to rise. What happened last week was, though, you had the TD raise their rate to 5.59% for mortgage qualification, other banks staying at 5.34%, and another bank, CIBC, staying at 5.14%. The only reason there's such a big spread is those banks know what their existing mortgage holders look like. And those banks know whether or not an increase in mortgage rate worked to their advantage or their disadvantage. And what it told me last week, Jim, was this. Toronto Dominion Bank knows, which is a well-known lender for first-time buyers, that their first-time buyers are coming up for mortgage renewal. And since they're first-time buyers, the bank knows it's going to be very difficult for them to move to another bank and have to requalify all over again. As a result of that, TD raised their rate the highest. On the other end, CIBC, they know that their mortgage holders are generally trade-up owners or owners of their third or fourth home. So they know that it's easier for those people to change banks because of the mortgage qualification rate really won't apply to them. In other words, they have an income level that would allow them to go to any bank that they wanted. And they've owned long enough that their mortgage is small enough to let that happen. What CIBC did was they, in turn, kept their rate lower than everybody else to try to keep their existing customers at their own bank. And that's exactly what you are watching happening live in real time right now across the mortgage marketplace. Now, you're not going to see these comments out there from other people talking about the mortgage market, but I think what I just told everybody would make logical sense when the only role of the bank is to get the highest profits possible for their bank.
Ross, is this the time to find yourself a real good mortgage broker?
Well,
or does that help?
Our belief is you should pay a mortgage broker separate from the transaction. In other words, let's say you're going to have a $200,000-$300,000 mortgage. I would not want my mortgage broker to be relying upon his income from him getting commission or fees from a bank. I would not want that to happen. Because right now there are about 49 lenders available. There's 49 lenders that we track. In order for you to get a totally independent, unbiased, and honest answer that benefits you the most financially, you need to give your mortgage broker the freedom to go ahead and give you the advice that you need. And what that means is you should be paying the mortgage broker for this advice. I can tell your listeners that if you pay a mortgage broker separate from the transaction, the mortgage broker will be able to save you more than what you're paying them. There is no good mortgage broker out there right now who could not give you advice that would save you more than what you're going to pay them. Now, everybody says, well, Ross, why would we do that? A mortgage broker can get paid from the bank. The second you allow them to get paid from the bank is now the mortgage broker's client. You are just a customer. And as a customer, you have no rights. It's the person who pays is the one that is the client. It is the person who doesn't pay that may receive services that is simply a customer. And the client is the one who the mortgage broker is really working for. They can tell you whatever they want. They can be the most ethical person in the world. But in the end, ethically speaking, they still have to represent the person who's paying them. And that is the lender. There is no consumer in Canada who should be working with a mortgage broker or a bank without hiring someone to represent them to go out and find them the best deal. That's what our philosophy is. That's how we approach it. We know that in the home province here of Ontario, mortgage brokers are under the mistaken opinion that they can't be paid under the way that we've just described. Fortunately for our clients or wealthy homeowner members, we have contacted the mortgage broker regulator ourselves to verify that our strategy was legal and that a mortgage broker could do it without breaking any rules. The regulator has told us they were shocked. The regulator didn't even know how to answer our question initially. The person we were talking to had to go talk to a supervisor. It took them about 20 minutes to even understand that what we were simply saying was, can someone pay for advice without having to book a mortgage?
Ross, it's just like supermarkets who said it was illegal for them to give away misshapen food and so on to food banks. No, it wasn't illegal. They just didn't want you to know that. We'll have more with Ross Kay right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Ross, on Tuesday, the Canadian Real Estate Association is set to release its April market review. What do you think we're going to hear, and what will be the truth?
Well, I think what you're going to hear, Jim, is the same thing we heard today with Terranet National Bank, a false reading of the market that in some parts of the country it's asinine, their market commentary. Today we heard that Vancouver, the Terranet National Bank House Price Index said that Vancouver had gone up about 15.8% year over year. Well, that's more than double what the average selling price increase. It is just unbelievable that these people get away with this stuff because it creates a false illusion of the market that inflates the housing bubble larger that will cause it to pop. The Vancouver housing market recorded a 29% drop in the market way back in the fall of 2016. That has not changed. What's changed is the compositional mix of the sales has moved towards condominiums and trade-up condominiums. In no way possible could they be claiming it's a 15.8% year-over-year gain in Vancouver. Tomorrow, what I expect you're going to hear is, you're going to hear the Canadian Real Estate Association tell everyone that it's not as bad as what it was in March. They're going to tell all of the home buyers out there looking for homes that the market is starting to stabilize. That's what I really suspect they're going to say, Jim. They're not going to tell anyone that, as far as my data shows, we're arguably the greatest single month of house price loss has just occurred in the country of Canada. It's never happened before. They're not going to mention that. They're going to use their year-over-year comparisons of April of 2018 against April of 2017, when we all know single detached homes in Vancouver were not selling at all. I mean, as they're not selling this year. But that 2017 number, of course, was compared against the 2016 number. And now they're going to compare the 2018 against 2017. Skewed the viewpoint last year, skews the viewpoint this year. Consumers are misled. Consumers go out and buy. The consumer, the home buyer, will not be told the truth tomorrow. The real estate agents across Canada, Korea, BCREA, OREA, all of the trade organizations, all of the franchise brands, Royal LePage, Remax, Sutton Group, Century 21, they are all out there right now trying to drive sales so that their members and their franchise brand users can make enough commission that they can continue to pay their bills. It is nothing other than that is what's going on. There is no way that the Canadian Real Estate Association, seeing that sales have a potential to drop by 20% this year in Canada, can go out there and tell Canadians, no, you shouldn't buy a home right now because housing prices are falling, sales are falling, and we could be getting into some real trouble because interest rates are rising. You will not hear that tomorrow. You didn't hear that from the British Columbia Real Estate Board. You didn't hear it from OREA. You're not going to hear it anywhere. Everyone knows, all of the listeners know, that I'm an advocate for home ownership. But I'm also an advocate for getting into the market at the right time, and if you're going to exit the market, exiting it at the right time. What your listeners need to understand is this, is that in 2011, if you had purchased a portfolio of $1 million worth of BC real estate 20 years earlier, you would have had a compounded annual growth rate of over 7.5%. If you had looked this month, April, and you had purchased a portfolio 25 years ago, you would have only watched a 5.3% compounded annual growth rate in your real estate portfolio of $1 million take place. That is a massive difference. 2%, over 2% per year for 25 years. By buying 25 years before 2011 or 25 years before 2018. The real estate cannot tell you may need to wait 2 or 3 years before you enter the market. But if you wait 2 or 3 years, you could end up saving hundreds of thousands of dollars. Organized real estate can't do that because they need commissions. They need sales. They need the franchise fees to be paid, the desk fees to be paid, the lights to be kept on, the Canadian Real Estate Association membership numbers to stay at 145 or whatever the heck it is right now. The Canadian Real Estate Association, in the last Great Correction, they lost 40% of their members. They almost went bankrupt. They can't afford to do that. They don't have a reserve that will weather a 10-year correction. And that's what your members need to understand when they hear, your listeners need to understand tomorrow when the stats are released. Every single stat is created for one reason and one reason alone, to direct you to buy a house tomorrow for the highest price possible.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Ross Kay. Ross, one of our listeners wants to know how the market is doing in the lower mainland when it comes to condos. Can they expect prices to come down, or are they going to continue to go up? Or is it the old location?
Yeah, it's location, which really means quality. So if your listeners are looking to see the selling prices released by Organized Real Estate or the benchmark prices, to see a huge drop in Vancouver in a short period of time, I'll tell you that you will not see that. You're not even seeing it with the single detached class of homes in Vancouver, where we know that same house year-over-year sales, well, off peak are off over 30% in a lot of cases right now. But you don't see those numbers released by organized real estate, so then you don't believe that that's to be the case, and you go out and you will overpay for a property as prices are falling. The condominium market is a little bit different, which people have to understand about Vancouver versus Toronto. The ratio of single detached to condos is a metric that you follow so you understand where there's going to be price pressure in a market at any given moment in time. Vancouver, because our single detached houses are still so far out of reach, really, for the vast majority of people, that is almost a component of the housing stock that is not attainable right now. Now, as prices continue to fall and no buyers are found, the snowball effect comes into play and prices deflate even more. But in the condos, people are going to become entrenched, and that's what you're going to see in Vancouver. You've got new condo stock that's been under construction for a while and will be under construction for the next 2 years that comes on stream. What will happen is that the resale market will freeze, and the buyers that we're right now having to buy in the resale market will buy the new homes that are being flipped. And those flips will no longer be being flipped on a profit margin. They will begin to be flipped at market, the price they paid, or even at a loss, because that's how flips transition as a housing market moves forward. We're already seeing this already in the GTA, where this is ongoing already right now. At the same time, you're hearing about record condo price gains. Well, you have to look at what's happening. If your listeners understand from what we've said here on the show for a couple of years, it is not the average selling price. It's the average purchase price. As interest rates rise, the average purchase price drops. There is no argument about it. There is no way to avoid it, barring huge wage increases in your municipality or short-term capital inflow from some other outside source. That does not go on forever. And then you also have to realize groupthink. The groupthink that has led to crazy house price gains across Canada the last couple of years is the same groupthink that leads to crazy house price declines. It's irrational on the way up. At a certain moment in time, it diverts from reality, and it's irrational on the way down. Again, diverting from reality. But at the same time, you're not going to see a lot of fluctuation in average selling prices or benchmark prices, because the methodology for those two items simply track how much buyers are able to spend. And that's what you're seeing in the condominium market. So, depending on the type of condominium you're looking to buy, what category it is, depending on the quality of the condominium that you're looking to buy, what features it has, how old is the building, does the building have certain amenities, does it not? All of these factors come into play, and you have no idea if prices are rising and falling unless you're tracking that category of home over the entire Greater Vancouver area. You can't pick one building and look at it, because its quality could be dictating that people start moving from lower quality buildings, and they're able to pick the higher quality building you're looking at no additional cost. So the demand on that building maybe stays higher. What you maybe should have been looking at is the building with the lower quality, where the prices are actually falling because no one will buy them. That's a complicated answer to that question, which really, it's an easy answer. Unless you're measuring the quality of home that you're looking at on a consistent basis. Everybody else is going to mislead you, and you are going to pay a huge financial price, as everybody is starting to find out now, and over the next 6 months, it's going to roll out even more.
Ross, is this a concern for someone who is, as I say, you're just looking for the place to live, where you want to live, and if the price of the house falls later, you don't really care because you're not planning to sell it, say, in the next 15, 20 years anyway?
If you are over 55 and you don't have it, and your kids have moved on, or you don't have any kids, then what you're saying would be true, Jim. Okay, so that's true. Yeah, my wife and I, we want to buy a place. We're going to live there for the next 15 years. Want to know something? As long as you can afford it, I really couldn't care if the price goes up and down. I really couldn't care, because you're going to stay there. Your listeners need to understand is the cost of home ownership is not what your mortgage in principal is. That is a myth. Your cost is what the true cost of owning a home is. Now, if you're a couple who's over 55 and your kids have gone on and your life is well set up and you're looking towards retirement, it doesn't matter. You look at the cost of what that house is going to cost you each year for the next 15, 20, 30 years, and you make a decision whether or not that building is worth what you think it is. It's worth the price, the cost. If it's not worth the cost, then you shouldn't buy it. It should have no bearing on your situation, but you shouldn't buy it. I know a lot of people in the over 55 age group, and I know they're going to continue to own for the next 30 years, 55 to 85, so say 25 to 30 years are going to continue to own. They shouldn't even worry about the market. Now, could they take a hit on their home equity? Sure, but that doesn't make any difference because they're not going to sell anyways. The only time the equity hit takes is when you're going to sell. Now, if you're under 55 or you have kids, that's a different story. Those people do have to worry about a correcting market because their ability to move up the property ladder will be greatly reduced, and it is going to come with a huge, huge financial cost. It's in many instances, I don't think a lot of people will even ever get over the cost with what our forecasts are projecting right now. If you're that under 55 with a family and you're going to still be moving up the property ladder, I don't know how long it's going to be. It could be 25 years before the financial damage gets unwound. So, the real estate agents use the generalization, as long as you're going to stay there, you don't have to worry about it because you don't have the loss until you sell. Yes, that's true. If you're over 55, you don't have any kids, and life is moving forward. But for everybody else, that is a myth. That is an old story used to get those CREA members their commissions so they can stay members of the Canadian Real Estate Association. So the Canadian Real Estate Association staff and economists and phone operators can all stay employed. That's exactly what's going on. And they are willing to compromise the financial future of the vast majority of Canadians to make that happen.
Ross, thank you so much for chatting with us.
Hey, thanks a lot, Jim.
My guest has been Ross Kay. You can contact him through the wealthyhomeowner.ca. If you have any questions for Ross or for the show, you can email us at info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of House Street Media Incorporated.